Welcome to the CFA Level 1 exam style questions and answer. In today's video, we will cover questions relating to the topic of cost of capital. So question number 1 is about stock splits. What is meant by stock split is this is actually a management tool that is being used to affect the share price. For example, if our share price goes very high, for example, $1,000, this will deter a small investor from buying into our share. So what we will do, we will divide this $1,000 share into 10 shares of $100 each. In this way, shareholders, small shareholders, will be able to buy our company, and this also will increase the number of shares in issue and hence increase the liquidity of the share. Increasing the liquidity will decrease the share risk. So if the liquidity risk is removed, then the share price should ideally go up. So what is the impact this might have? It will increase the firm value? No, it will not, because we just divided them into 100 shares each. The 10 of shares will be again with the same value of 1,000. Do not in and of themselves. What that means? That means apart from other factors, just splitting it has no effect on the firm value. Actually, this is the right answer, because the share price might go up, but because of factors other than just the split itself. Like, for example, the reduction in the liquidity risk will also boost the share price. But everything else kept constant, this will not increase the share or the firm value. Number C are less common than stock dividend. Both of them are uncommon. So the answer is number B, definitely. Question 2, in order to more accurately estimate the cost of equity for a company situated in a developing market, an analyst should do the following. Normally we calculate the beta using the capital asset pricing model as a measure of risk specific to that company. Normally we take the beta from the United States market, which is very developed, it's not developing, and it is also information risk. So the information rich, the information risk will be very low, and beta, again, if the risk is very low, beta will be small. So we need to add factor to accommodate the new risk relating to operating in a company that is still developing. So what we'll do, add country risk premium. Yes, we add the premium to that beta. To the risk-free rate of return, no. The risk-free rate of return normally remains the same. We add it to the risk premium, the market risk premium. So if you remember, the capital asset pricing model formula is market return minus risk-free rate of return. This difference is called market risk or risk premium. So we add the country risk to the market risk premium. Use the yield on sovereign debt of that developing country as a risk-free rate of return. This is not right, because we normally fix the risk-free rate of return. We will use it in the capital asset pricing model to add to the market risk. Add the country risk premium to the market risk premium. That is the right answer, and we adjust that so that the beta will be multiplied by the risk premium. Please go back to the capital asset pricing model video on this channel, and I will provide the link to the description box. Question number 3. The after-tax cost of preferred stock is always, before we go further, preferred stock pays dividend. Dividend is not tax deductible because it is part of equity. Any amount paid to equity, regardless of common equity, preferred equity, or any other form of equity, this is not tax deductible. So after tax or before tax, it is the same because it has nothing to do with the tax. Less than the before, no. Equal to the before, yes. Before tax and after tax, it is the same because tax is irrelevant in case of equity. Let us move to question number 4. ABC Incorporated is in a 40% marginal tax bracket. When you see the tax rate, do remember the expression 1 minus t. That is 1 minus 40% will give 60% or 0.6. The firm can raise as much capital as needed in the bond market at a cost of 10%. So bond means debt. So the cost of debt is 10% before tax. After tax, we should multiply the 10% by the expression 1 minus t, which is 1 minus 40. The preferred stock has a fixed dividend of 4. So the company pays $4 to each preferred stockholder. And the preferred stockholder pays $31.5 to buy this in the market. So the yield to the preferred stockholder is 4 divided 31. That is the return to the preferred stockholder. That return represents a cost of the preferred stock in the eyes of the company. So the after-tax cost of debt and preferred stock are closest to. Definitely the word after-tax cost relates to debt and not preferred stock, because preferred stock has nothing to do with tax and it is not tax deductible. The answer given is debt, this figure, and preferred stock, this figure. Let us calculate the after-tax cost of debt of the company. After-tax cost of debt is the 10% minus hours multiplied by 1 minus t, which is 6%. And the cost of the preferred stock without the word preferred is 4 divided 31, which is 12.7. That gives the answer C is the right answer. Question number 5. To finance a proposed project, ABC Incorporated would need to issue 25 million sterling pound in common equity. So the company has a new project, and in order to finance that project, the company opted for the equity method of financing, and they have to issue new share and collect 25 million sterling, and that will be the new equity. However, ABC would receive 23 million pound only, or sterling pound only, because the difference will be the flotation cost, that is the cost of bankers, cost of consultant like tax expert fees, accountant fees, legal fees. So all these amount to 2 million because we are going to receive net 23. How we record this in the book of account? We said debit bank 23 million, debit flotation cost of 2 million, which is part of the profit or loss account, and then we credit the whole 25 million to the equity. So equity is 25 million. Now the question is, the 2 million flotation cost to the project initial cash outflow. Do we add this? Because normally we do the net present value calculation. We estimate all the cash in and cash out. The cash in the first year to start the project, we call it initial outlay or initial cash outflow, as mentioned in the question. We consider this 2 million part of these cash outflows, or we shouldn't consider it because it is a sunk cost. Sunk cost, these terms refer to the stage at the decision-making process. If I'm going to take a decision whether to take that project or not, I will consider sunk cost. It's already done and it is irrelevant for the decision. However, in this case, the decision is already made and the company is going ahead with the project. So the word sunk cost is not part of that. The 8% flotation cost, which I think the 2 million divide the figure, will give 8%. Here, the answer is to add this 8% to the equity cost. That doesn't make sense because the equity normally costs 11, 12, 13, 14%. Do we want to add 8% to make it more than 20%? Definitely the answer is the first one. We consider this as initial outlay because we pay the 2,000 or so 2 million to the consultant. Let us move to question number 6. The most accurate way to account for flotation cost when issuing new equity to finance a project is to, the word to account for is not meant double entry accounting. No, how to handle the flotation cost. And we just mentioned this in the previous slide. We said that this will be added to the initial outlay of cash outflow. Increase the cost of equity, definitely wrong. Increase the cost of equity capital by dividing 1 minus flotation, 1 plus flotation. All these are irrelevant and wrong answer. Adjust cash flows in the computation of the net present value of the project by the dollar amount we paid. We have seen just now in the previous slide that 2 million has been deducted from the cash the company generates. That is cash outflow. So C definitely is the right answer. Let us move on to question number 7. MPC Incorporated has a capital structure that is comprised of 60% common equity and 40% debt. So the capital structure is 60 to 40%. The company will raise $1.6 million by issuing common equity and debt in proportion to its current capital structure. So the 1 million will be 60% of it will be new shares and 40% of the 1.6 million will be debt. The debt will be issued at par with 9% coupon, that is the cost of debt before tax. And flotation cost on the equity issue will be 3.5%. As we just mentioned in the previous question, 3.5% of the 60% of 1.6 million, which will be issued to equity, will get an amount that will be used in the calculation of the net present value as cash outflows and had nothing to do with the weighted average cost of capital. The company common stock is currently selling for $21.4 per share. That is the currently the share is trading at this much. So if a new investor want to buy a share, the cost for the investor will be this much, and its last dividend was 1.8. So the dividend today divide the amount of the share price will give the dividend yield to investor. So the investor will make this money in percentage. That percentage is the equity cost for the company. However, this dividend expected to grow. If you remember the Gordon gross model for valuation, we deduct the percentage of gross and we add it back when we calculate the total. We'll see this in a minute. The company's tax rate is 40. So 1 minus 40, 1 minus T, times 9% will give the cost of debt to the company after tax. So the company's weighted average cost of capital based on the cost of the new capital is closest to, let us see the answer. These are the answer given. To calculate the weighted average cost of capital, we need two components. The structure of the capital, which is 60%, that is the weight of the common equity, and 40% is the weight. When you hear the word weighted average, so the weight here of debt 40% and the weight of equity 60. We will multiply the 60 as a weight to equity by the cost of equity. And we will multiply the weight of 40% of the debt by the cost of debt after tax cost of debt, which is 9% times 1 minus t. Let us first find out the cost of debt. This is the cost of debt. 9%, which is before tax, times 1 minus t, 40%, will give 5.4%. This is after tax cost of debt times the weight. And then we add 60% to the, which is the weight of equity, to the cost of equity. Now, we need to calculate the cost of equity, as I mentioned, using the gross model, dividend gross model, which is cost of equity equal current equity dividend, which is 1.8, times 1 plus 0.7. 7 is the gross. By multiplying this figure by 1.07, I will get next year dividend. So the company is going to pay this much as dividend, which is 1.8 times 1.7. We'll get some figure close to $2 or maybe $2. I didn't calculate that. So this is the dividend I'm going to receive, divide the price I'm going to pay today. That will be the yield for the shareholder. That is me. That yield is the cost of capital to the company. However, this yield is for next year, but this will grow year after year. So I have to add the 7%, which is forever increase. That will give us 16% equity cost. So the equity cost times the weight of the equity plus debt cost times the weight of debt will give the weighted average cost of capital. That is 60, the weight of the equity times 16, the cost of equity, 40%, the debt weight times 5% cost of debt will give 11.76. So the answer is number B. We will now move to question number 8. A company is primarily engaged in the production of cement has the following characteristics. Beta 0.8, market value of debt is this much, market value of equity, effective interest rate, and marginal tax rate. We always use the marginal tax rate because the effective one is accounting terminology. It has different complications. Always use the marginal tax rate. The question is the acid beta that should be used by a company considering entering into cement production is, what is meant by acid beta? We know beta, but what is meant by acid? When we calculate beta, the capital structure of the company, that is the level of debt and equity, affect the risk. The more debt we have in our capital structure, the higher the risk. So equity holder will ask for more return to compensate them for this risk. Hence, the weighted average cost of capital will be higher. What is meant by the acid beta is the beta without considering the debt. We have to remove the effect of debt and get the acid beta. Why we do that in the first place? For example, if we are going to buy a company in another country which has its own capital structure, which is different than the parent, we can't use the weighted average cost of capital of the parent because the debt structure, the cost is, the capital structure is totally different. So the risk profile also will be different. But this is not the point here. The point, we have this figure and we want to calculate the acid beta. So to answer this question, we need to remove the effect of debt by a formula called beta unlevered. That is removing the effect of leverage. So These are the answer given to us. Which one of these is the acid beta? Let me bring the formula we use in the previous video. I have a video here about calculating acid beta. I will provide the link to this video here. But let us bring the equation. The equation says beta unlevered equal beta with the leverage. This one, beta with the leverage divided by 1 plus 1 minus tax. This is always there. Debt divide equity. Okay. Beta unlevered, which is acid beta, equal beta levered 0.8. 1 minus tax. Tax is a marginal. 1 minus 34. Time debt over equity. This is the market value of debt, and this is the market value of equity. By plugging this figure, we get this answer, 656, which is this one. So answer B is the right one. 9. A new project is expected to be less risky than the average risk of existing project. The appropriate discount rate to use when evaluating this project is, we'll get some answer. But before going into the answer, as I mentioned in the first video, that what is important, how to approach the question, not the answer themselves. Now, the point here is, if you recall from previous videos on this channel, I mentioned several times that there is a risk and reward. The higher the risk, the higher the expected return to compensate the investor for shouldering higher risk. So if the risk is less, the expected return is less. Makes sense, because the relationship is linear. The higher the one, the higher the other one. Less than the firm marginal cost of capital. No, it means less. Less means that it is less risky, and the discount rate should be also less. That is right. But let us see the other answer. Greater than the fair marginal cost of capital, because it is less risky, it will demand more return. That doesn't make sense. This is inverse relationship. As I just mentioned, the relationship is linear. The higher, the higher. The lower, the lower. See the firm's marginal cost of capital? No, since the risk profile is different. So the answer is A. Let us go to number 10. An analyst gathered the following information about a capital budgeting project. We have this project. The proposed project cost $10,000. That is the initial outlay in any calculation. It is cash outflow, so a negative 10,000 cash outflow. The project is expected to increase pre-tax, this is very important, net income and cash flows by 3,000. We need to find after-tax cash flow. Normally, again, as I mentioned this in previous videos on this channel, that we always use after-tax cash flows. So we need to remove the tax from the cash at a rate which will be given in the next 8 years. So we have cash flows for the next 8 years. The company has 50% of its capital in equity at a cost of 12. The pre-tax cost of debt is 6% and the company's tax rate is 33. So pre-tax must go after tax 6% times 1 minus T. The project net present value is closest to, these are the net present value of this project. So we need to decide the discount factor, which is the weighted average cost of capital. The weighted average cost of capital is calculated by the percentage or the weight of debt and the weight of equity. So if we have 50% equity, that means we have 50% also debt. These are the weight. We multiply the weight of each component, equity and debt, by the cost of that component. So 50% times 12% for the equity cost, and 50% times 6 times 1 minus tax will give the debt cost. Together will give us the weighted average cost of capital. 12% cost of equity times the weight of equity 50%. 50% I also the weight of the debt times the cost of debt times 1 minus T. This will give us a factor of discount factor of 8%. I could do the calculation here, but I prefer to go to Excel and show you how to do this in a simple way. Okay, here is the Excel sheet. On the first year, there is a cash outflow of $10,000. This will be discounted at a discount factor of only 1, because in year 1, we don't discount. It has the same value. So this time this will give the same. So the first year we will have $3,000, but we need to remove the tax, which is 33%. So times 0.67. This is the net cash or the after-tax cash for the next 8 years. How to calculate the discount factor at 8%? I'm going to give you a simple way, which is say 1 divide bracket 1 plus 0.8%, this one. So this is a discount factor. To get the other factors, you just need to say this divide 1.08. 08 is a, or simply we can make it as we did it in the last cell. We will say this plus this one. And then you drag the equation. Here we drag the equation and we get the answer $1,551. Let us see that in the presentation. 1,551. So the answer is 1551. With this we come to the end of today's video. Please do subscribe to the channel.